Welcome back to our channel where we break down complex stocks into simple, actionable insights. Today we are diving deep into one of India's most talked about private sector banks, South Indian Bank. By the end of this video, you will know exactly whether this Kerala-based lender deserves a spot in your portfolio or if you should steer clear. Now, before we jump in, you have probably heard mixed opinions about South Indian Bank. Some call it a hidden multi-bagger waiting to explode, while others warn it as just another small bank struggling to compete with giants like HDFC and ICICI. The truth? Well, that is what we are here to uncover today. So grab your favorite beverage, settle in, and let us explore everything you need to know about South Indian Bank's investment potential in 2025. The bank's journey, from Kerala roots to national ambitions. Let us start with some context. South Indian Bank is not some new fintech startup, it has serious heritage. Founded way back in 1929, this bank has been serving customers for nearly a century. Think about that for a moment. It survived the independence movement, multiple economic crises, and countless banking reforms. The bank started its journey in Thrissur, Kerala, and for decades remained primarily a regional player. But here is where things get interesting. Over the past few years, South Indian Bank has been aggressively expanding beyond its traditional Kerala stronghold. Today, the bank operates 955 branches across 26 states and 4 union territories with over 1,285 ATMs, serving more than 7.8 million customers. Now, compared to giants like State Bank of India with thousands of branches, this might seem small. But remember, it is not always about size, it is about efficiency and growth potential. What makes South Indian Bank unique is its strong presence in the NRI remittance market, particularly from Gulf countries. The bank has a representative office in Dubai and maintains excellent relationships with the Indian diaspora in GCC countries. This gives them a steady, low-cost deposit base, something that is incredibly valuable in today's competitive banking environment. Recent performance, the numbers that matter. All right, let us talk numbers because that is what really matters for us as investors. South Indian Bank's recent performance has been quite impressive, and I will break it down quarter by quarter so you can see the trends. In the second quarter of financial year 2025, the bank reported a net profit of rupees 325 crore, marking an 18% increase from rupees 275 crore in the same quarter last year. That is solid growth, but what is more encouraging is the consistency. The bank has been posting steady profit growth for several quarters now. But here is the real story. Their first quarter of financial year 2026 results were even better. Net profit jumped to rupees 322 crore, representing a 9.5% year-on-year growth. Now, you might say 9.5% does not sound spectacular, but in banking, consistent single-digit to low double-digit growth is actually quite healthy. The bank achieved its highest ever total business of rupees 2,119 crore in the first quarter of financial year 2026. Operating profit surged by 32% year-on-year, reaching rupees 672 crore. This tells us that the bank is not just growing its top line, but also improving operational efficiency. What really caught my attention is the asset quality improvement. Gross NPA dropped to 3.15%. From 4.50% a year ago, that is a massive 135 basis points improvement. Net NPA fell even more dramatically to just 0.68% from 1.44%. These are some of the cleanest asset quality metrics you will see in the banking sector. The provision coverage ratio hit a record 88.82%, including write-offs. This means the bank has adequately provided for potential losses, giving investors confidence in the sustainability of their earnings. Financial health. Deep dive, what the balance sheet reveals. Now, let us get into the nitty-gritty of the bank's financial health, because this is where you can spot red flags or green signals early. Starting with capital adequacy, South Indian Bank maintains a robust capital adequacy ratio of 19.48% as of June 2025. The regulatory minimum is 11.50%. So the bank has a comfortable cushion of nearly 8 percentage points. This strong capital position means the bank can handle economic shocks and support loan growth without needing to raise expensive equity capital. The Tier 1 ratio stands at 18.25%, which is entirely common equity Tier 1. This is important because it represents the highest quality capital that can absorb losses while the bank continues operating. Let us talk about deposits, the lifeblood of any bank. South Indian Bank's deposit base has been growing steadily. Total deposits reached rupees 1,12,921 crore in the first quarter of financial year 2026, with retail deposits growing 9.65% year-on-year to rupees 1,09,368 crore. The CASA ratio, that is current and savings account deposits, which are typically low cost, stands at a healthy 32.06%. What is particularly impressive is their NRI deposit base, which grew 7.27% to rupees 32,293 crore. Remember, NRI deposits are typically sticky and provide geographic diversification, which is valuable during domestic economic downturns. On the lending side, gross advances grew 8% year-on-year to rupees 89,198 crore. The bank is strategically shifting its portfolio mix towards higher-yielding retail and MSME segments. Personal loans jumped 26% to rupees 24,222 crore, and housing loans more than doubled with 66% in growth to rupees 8,518 crore. Here is something that sets South Indian Bank apart: their gold loan portfolio. At rupees 17,446 crore, gold loans represent a significant chunk of their business. Gold loans are typically high-margin, short-term products with excellent recovery rates, since they are backed by physical gold collateral. Competitor comparison. Where does South Indian Bank stand? When we talk about South Indian Bank, we cannot ignore the competition. The Indian private banking sector is dominated by heavyweights like HDFC Bank, ICICI Bank, Axis Bank, and Kotak Mahindra Bank. Then there are mid-sized banks like Federal Bank, RBL Bank, and Bandhan Bank, which compete more directly with South Indian Bank. Now, compared to these giants, South Indian Bank might look tiny. Its total business is just over 2 lakh crores, while HDFC Bank alone has crossed 20 lakh crores. But here's the twist: smaller banks often have higher growth potential. Think about it. Growing from 2 lakh crores to 4 lakh crores is much easier than growing from 20 lakh crores to 40 lakh crores. Another interesting comparison is with Federal Bank, which also has Kerala roots. Federal Bank has already scaled up impressively with a business of over 4 lakh crores and has established itself as a strong mid-sized private bank. Many analysts believe South Indian Bank is trying to replicate a similar journey, focusing on asset quality improvement, digital banking initiatives, and steady expansion outside Kerala. In terms of profitability, South Indian Bank's return on assets stands at 1.2%, and return on equity is around 11%. These are decent, but still lower than industry leaders like HDFC Bank, which posts ROEs of 15 to 18%. However, the trajectory matters. South Indian Bank has been improving its metrics quarter after quarter. Growth opportunities, the bullish case. So, what makes South Indian Bank an attractive investment opportunity right now? Let us break down the bullish arguments. Number 1, niche in gold loans. As I mentioned earlier, their gold loan book is substantial. With India's cultural affinity for gold and with gold prices hovering at all-time highs, this segment offers both growth and profitability. Number 2, strong non-resident Indian base. With millions of Indians working in the Middle East and Gulf countries, remittances are expected to remain strong. South Indian Bank's established reputation in this segment gives it an edge over competitors. Number 3, digital transformation. The bank has been investing heavily in digital platforms, mobile apps, and online services. This is critical because younger customers demand seamless digital experiences. In fact, over 60% of new account openings are happening digitally. Number 4, asset quality improvement. The sharp drop in non-performing assets is a clear signal that the bank is getting its house in order. If they can sustain this trend, valuation re-rating is very likely. Number 5, undervalued stock price. South Indian Bank stock is trading at less than 1 time its book value compared to Federal Bank at around 1.3 times and HDFC Bank at nearly 3 times. This means the market is not yet fully priced in its recovery story. For value investors, this could be a golden opportunity. Risks, the bearish case. Of course, every investment comes with risks. Let us be honest about the bearish side too. First, competition. The bigger banks with stronger balance sheets can easily eat into South Indian Bank's market share, especially in urban areas. Second, regional concentration. Despite expansion, nearly 40% of the bank's business is still concentrated in Kerala. Any economic disruption in that state, like floods or political unrest, could significantly impact performance. Third, limited brand recognition. While names like HDFC and ECICI carry instant credibility, South Indian Bank is still building its national image. This could slow down customer acquisition outside its core market. Fourth, thin margins. The bank's net interest margin is around 3%, which is lower than industry leaders. Until margins improve, profitability will remain under pressure. Fifth, execution risk. Turning around a legacy bank is not easy. It requires consistent leadership, disciplined execution, and flawless risk management. One wrong step could set back years of progress. Analysts view what experts are saying. Now, let us hear what the experts have to say. Brokerage firms like ICICI Securities and Motilal Oswal have recently upgraded their ratings on South Indian Bank, citing improved asset quality and strong earnings momentum. For instance, one report projected that the bank could post a return on equity of 13 to 14% over the next 2 years, which would justify a higher valuation multiple. However, not everyone is bullish. Some analysts caution that the rally in the stock price, which has already doubled from its lows, may have priced in much of the good news. They advise investors to wait for further confirmation in the next 2 quarters before making big bets. Outlook. What lies ahead in 2025 and beyond? Looking ahead, South Indian Bank's strategy seems clear. Grow retail loans, strengthen digital channels, and expand outside Kerala. If they execute well, they could gradually transform from a small regional player into a respected mid-sized national bank, much like Federal Bank did in the past. The macroeconomic environment also looks supportive. With India's GDP projected to grow at 6 to 7% annually, credit demand is bound to remain strong. Rising gold prices could further boost their gold loan segment, while non-resident Indian remittances are expected to stay robust. The only question is whether South Indian Bank can consistently deliver quarter after quarter. Investors should keep an eye on asset quality, margins, and branch expansion plans. Verdict: should you invest? So here's the big question: should you invest in South Indian Bank? If you are a conservative investor who prefers established giants like HDFC or ICICI, then South Indian Bank might feel too risky for you. But if you are a value investor willing to take calculated risks for potentially higher returns, this bank definitely deserves a spot on your watch list. At current valuations, the risk-reward ratio looks favorable. But remember, position sizing is key. Do not put all your money into one small-cap bank. Instead, consider allocating a small portion of your portfolio to South Indian Bank as a potential high-growth bet. Final thoughts. To sum up, South Indian Bank is a classic turnaround story. It has strong heritage, improving fundamentals, and niche strengths in gold loans and non-resident Indian deposits. But challenges remain in scaling up nationally and competing with larger peers. As always, do your own research before investing. And remember, the stock market rewards patience and discipline.